There is a document circulating inside 3 sovereign wealth funds right now that does not mention XRP by name. It describes a settlement asset. It describes a bridge mechanism. It describes a neutral instrument capable of moving value between regulated stablecoins without touching the correspondent banking system. Every specification in that document points to one ledger, and the people reading it already know which one. The most important movements in financial history are never announced. They are documented after the fact by analysts trying to explain how the obvious was missed. We are living inside one of those moments right now, and the difference between those who will look back and understand and those who will look back and ask how it happened comes down to a single capacity: the willingness to read the architecture instead of watching the price.
Serious. What I am about to walk you through is not being explained to retail investors the way it should be. It is being treated as a series of disconnected news stories. An ETF inflow here, a custody arrangement there, a stablecoin expansion in a market most Western analysts do not cover. A regulatory framework being assembled in committee rooms most viewers will never see. But these are not separate events. They are one mechanism, observed from different angles by people who do not yet realize they are describing the same machine. The mechanism has a structure. The structure has stages. And one of those stages, the one with the least public visibility, is also the one with the largest consequence when it activates. That is the stage we are going to unlock today. Welcome back. I am the Calm Analyst.
Today, we pull back the curtain on what the institutional world is quietly assembling beneath the surface of the XRP market, and why the structure being built right now is no longer a thesis. It is a system entering its final configuration. Let's go under the surface. Make sure to like and subscribe and drop a comment below with your opinion on XRP. And watch until the end, because the final minutes reveal why July 13th could change everything. Let me start with the hard truth most of the market has not absorbed yet. Roughly 90% of the conversation around XRP is still being conducted at the wrong altitude. People are watching the price. People are watching the daily candle. People are watching the latest social media commentary from accounts that have never read a single institutional filing. And while that conversation continues at street level, an entirely different conversation is happening in conference rooms in Tokyo, Singapore, Zurich, and Abu Dhabi. That conversation is not about price. It is about plumbing. To understand why XRP is positioned the way it is right now, you have to understand a concept that almost no retail investor has been taught: shadow liquidity infrastructure. Shadow liquidity is the layer of financial movement that exists beneath the public market. It is where institutions accumulate, where over-the-counter desks settle blocks, where escrow mechanics determine real available supply, and where custodial relationships quietly remove assets from circulation for years at a time. You see, retail investors look at the circulating supply number on a data aggregator and assume that is what is available to buy. Financial institutions do not make that mistake. They calculate functional float, the supply that is actually accessible without disturbing market structure. And the functional float of XRP today is dramatically smaller than the headline number suggests. David Schwartz has been describing this asymmetry for years, though rarely in language the retail audience picks up on. He talks about enterprise adoption on the ledger accelerating. He talks about tokenized real-world assets settling in volume. He talks about liquidity corridors deepening in regions that do not appear in Western coverage. Every one of those statements is a description of supply being absorbed by utility, supply that does not return to exchange order books. Brad Garlinghouse has been more direct, but only when speaking to institutional audiences. His public statements at financial conferences in Asia have consistently described XRP not as a speculative asset, but as settlement infrastructure for the next generation of cross-border payment architecture. That is not marketing language. That is the language used by the Bank for International Settlements when it describes the future of correspondent banking. And here is the part that the retail market still has not connected. When Franklin Templeton, a firm managing $1.7 trillion in assets, confirms that they have been engaged with Ripple in Asia for years, predating the ETF cycle, predating the legal resolution in the United States, what they are confirming is that the institutional case for XRP was never dependent on the American narrative. The American narrative was the distraction. The build was happening elsewhere. So when you ask yourself why the price has not yet reflected what appears to be an overwhelming convergence of catalysts, the answer is not that the thesis is wrong. The answer is that the mechanism being constructed is operating on a different time horizon than the retail market is calibrated to perceive. The institutions are not waiting for the price to move. They are positioning before the price moves. That is the difference between watching the market and being the market. Now let's do the math the retail crowd ignores. The global cross-border payments market processes approximately $150 trillion annually. The foreign exchange market clears around $7.5 trillion every single day. Sitting beneath all of that is roughly $27 trillion locked in Nostro and Vostro accounts. Pre-funded liquidity that exists only because the current settlement system cannot move value in real time across borders without it. That $27 trillion is the prize. It is dead capital. It earns nothing. It exists purely as a workaround for a settlement architecture that was designed in an era when financial messages traveled faster than financial value. Every major central bank, every major commercial bank, and every major payment processor in the world has acknowledged, in writing, in published research, that this architecture is obsolete. The question is not whether it gets replaced. The question is, what replaces it? Now apply the math. The total supply of XRP is fixed at 100 billion tokens. Circulating supply is approximately 57 billion. Functional float, the portion actually available without disturbing market structure, is materially smaller once you subtract ETF custody, OTC desk inventory committed to institutional buyers, corporate treasury positions being assembled under the emerging United States market structure framework, and tokens absorbed into long-term cold storage arrangements that simply do not return. If XRP captures even 1% of the annual cross-border payments flow, the daily settlement volume routing through the asset is $1.5 billion per day. If it captures 5%, that figure is $7.5 billion per day. At a functional float that is shrinking, not expanding, the math forces a single conclusion. The price per token required to facilitate that volume without unacceptable slippage is structurally higher than the current price by a margin that the retail market has not yet modeled. This is not a prediction. This is a requirement. If you have a problem with the math, you do not have a problem with me. You have a problem with the laws of liquidity and the geometry of settlement systems. Let me give you the cleanest version of this calculation. To move $1 billion in value through XRP at a price of $2.50, you need 400 million tokens. To move that same $1 billion at $25 per token, you need 40 million. At $250, you need 4 million. As the price rises, the same settlement volume requires fewer tokens, which means less slippage, which means deeper effective liquidity, which means the asset becomes more capable of absorbing institutional flow at a higher price than at a lower one. This is the inversion that most retail investors never grasp. They believe a higher price makes XRP less useful. The opposite is true. A higher price is a precondition for the volume it is being engineered to carry. The current price is not a measure of its value. It is a measure of how early the cycle still is. While the retail conversation has been dominated by frustration, the institutional signal has never been stronger. Look at what Ripple has been acquiring. Hidden Road, a prime brokerage with deep institutional client relationships, was not a casual acquisition. It was a positioning move. The construction of an institutional gateway that gives sophisticated counterparties direct access to XRP-based liquidity through infrastructure they already trust. G-Treasury, the corporate treasury management platform, was a second precision strike. It places XRP-denominated settlement options directly inside the workflows of the corporate finance teams who manage trillions in working capital. Ask yourself this brutal question. Does a company position itself this way without certainty about what comes next? Firms do not assemble this kind of infrastructure on speculation. They assemble it because they have already mapped the terrain. The ETF data tells the same story from a different angle. The XRP spot ETF complex has absorbed approximately $1.3 billion in assets under management at a pace that fund managers themselves have described as unlike anything they have previously experienced. The industry benchmark for a successful ETF launch is reaching $5 million in the first year. Multiple XRP-linked products crossed $300 million in the first week. That is not retail enthusiasm. That is institutional positioning routed through the only vehicle that compliance committees can currently approve. Now layer in the regulatory dimension. The Digital Asset Market Clarity Act in the United States is moving through its rulemaking phase. The Genius Act framework for stablecoin oversight is creating the legal scaffolding that institutional treasurers have been waiting for. Japan's Financial Services Agency has been engaged with Ripple infrastructure for years, building the regulatory pathway for XRP-based settlement to integrate directly into one of the most sophisticated financial markets in the world. The European Union's framework is moving in the same direction. And then there is the central bank dimension. Jerome Powell has signaled openness to digital asset integration with the regulated financial system. The International Monetary Fund has published research describing the need for neutral bridge assets in a multi-currency settlement architecture. The Bank for International Settlements has run pilot programs that describe exactly the kind of functionality the XRP ledger provides. This is not coincidence. This is not retail FOMO. This is calculated positioning by the most sophisticated capital allocators on the planet, building the infrastructure for a settlement architecture that they intend to dominate. They are not asking permission. They are building the system, and they are doing it in the quiet. Now, let's talk about the catalysts that turn this hidden architecture into a visible market event. The first catalyst is the completion of United States market structure legislation. When that framework finalizes, the risk premium that has been suppressing institutional allocation to digital assets, particularly to XRP, which was singled out by the legal uncertainty of the past several years, disappears. The wait-and-see capital becomes all-in capital. The treasurers who have been modeling positions but unable to execute them gain the regulatory cover they require. The second catalyst is the activation of zero-knowledge identity infrastructure on the XRP ledger. This is the stage the retail market has not yet priced in because it is the stage they have not yet been told about. Zero-knowledge compliance allows institutions to verify regulatory requirements, sanctions screening, anti-money laundering checks, jurisdictional eligibility, without exposing the underlying personal data of their counterparties. This is not a technical curiosity. This is the layer that opens the door for the categories of capital that currently cannot legally participate in public blockchain settlement at all. When that switch flips, the universe of eligible capital expands in a single step by an order of magnitude. The third catalyst is the continued international expansion of RLUSD, Ripple's regulated stablecoin, which is already operating in Japan, across the African corridor, and in select European Union markets. As RLUSD expands into additional currency denominations, a euro version, a yen version, instruments denominated in regional currencies across Latin America and Southeast Asia, XRP becomes the neutral bridge asset between an expanding shelf of regulated digital currencies. Every new corridor creates recurring, non-speculative, structural settlement demand for XRP. The fourth catalyst is the depletion of over-the-counter desk inventory. At current institutional absorption rates, the supply of XRP available for large block private transactions outside of public exchanges is projected to be exhausted within a measurable window. When that depletion completes, institutional buyers face two options: go directly to Ripple or enter the public market. Either outcome compresses available float further. When these catalysts converge, the structural cushion that has been absorbing buying pressure for the past several years stops absorbing. The wait-and-see money becomes the must-act money. And the question is no longer whether the thesis will play out. The question is how quickly the market structure can reprice once the absorption layer is gone. We are moving from an era of abundance into an era of scarcity. This is not a marketing phrase. It is a description of what is happening to the available supply of XRP right now, this quarter, in measurable terms. Exchange reserves at the major trading venues, the centralized platforms where price discovery actually occurs, are at multi-year lows. Market makers, the firms that hold inventory and provide bid-ask liquidity, are operating with thinner books than at any comparable point in recent history. Sell walls that previously absorbed buying pressure are dissolving, and every dollar of new demand entering the market is exerting more price impact than it would in a deeper order book. Once a token enters a multi-signature institutional custody arrangement, it does not return to the market for a 10% profit. It does not return for a 50% profit. It returns when the strategic mandate that placed it there is complete, which in the case of settlement infrastructure means it may not return for years or at all. The institutions have spent years constructing the conditions under which they could accumulate without alerting the market. The legal uncertainty was a feature, not a bug, for the firms that understood what they were buying. It kept the price suppressed. It kept the retail audience confused. It kept the asset available at prices that will not exist again once the structural repricing begins. When the final regulatory switch is flipped, when the zero-knowledge layer activates, when RLUSD expands into its full currency shelf, the retail market will be looking at an asset that no longer trades the way it used to. You will not be buying whole tokens. You will be buying fractions. And the people who held through the suppression, who studied the architecture instead of watching the candles, will be the ones who provided the conditions for the institutional accumulation to complete. This is the part that history will record clearly. The exit liquidity of the confused funded the entry of the informed. That has always been the structure of major asset repricings. It is the structure of this one as well. I know it is difficult to watch the market in its current configuration. I know the headlines are designed to create fatigue. I know the price action looks, to the untrained eye, like a thesis that is failing. As an analyst, I am trained to distinguish between noise and signal. And I am telling you, with the calm precision the moment requires, what you are watching is not failure. It is the final stage of accumulation before structural repricing. Red candles in this phase of the cycle are not what they appear to be. They are smokescreens for accumulation. The FUD cycle is psychological warfare designed to shake weak hands into surrendering positions to the silent buyers who have been waiting years for this exact window. The boredom that has settled over the market is the silence of a predator that has not yet struck. Being early feels exactly like being wrong, right up until the moment the structure catches up to the math. While the masses are focused on whether the next candle is green or red, the smart money is locking custody arrangements, signing agreements that will not be made public for months, and assembling the infrastructure that will define the next decade of cross-border settlement. The question is not whether the price will recover. The question is, who will still be holding when the targets that today sound unreasonable become the new floor? Make sure to like and subscribe, and drop a comment below with your opinion on XRP. And watch until the end, because the final minutes reveal why July 13th could change everything. Price is a distraction. Architecture is the reality. The retail market is watching one screen. The institutional market is building another. And the gap between those two perceptions is the asymmetric information advantage that defines this entire cycle. You are watching the foundation of the next settlement system being constructed in real time, in plain sight, by the largest capital allocators in the world, while the public narrative continues to treat it as a speculative curiosity. History does not reward comfort. It does not reward conventional wisdom. It rewards those who paid attention when the room was quiet. If you made it to the end of this briefing, drop the word architecture in the comments below. I want to see who is actually paying attention to what is being built. If you value this kind of analysis, measured, structural, free of hype, subscribe and stay for the next briefing, which goes directly into the zero-knowledge identity layer and why it is the single most underpriced catalyst in the entire mechanism. In a market fueled by emotion and noise, we thrive on data and composure. The math does not lie. The system is almost complete. Stay patient, stay rational, and as we always do, we do not wait for the future. We position for it.